All right, let's talk about how to get started investing in stocks. If you've ever felt like it's too complicated or maybe even too risky, we're going to clear all of that up today. We're going to make it simple. So let me tell you a story about my dad, Mervyn. He was, one of the hardest working guys I've ever known. He was juggling a factory job and a side hustle, all just to provide for our family. And he believed the absolute safest place for his extra cash was a bank account with basically no interest and, I'm not kidding, an actual shoebox. But here's the thing my dad didn't realize. He was playing a really, really risky game without even knowing it. See, every single year, that hard-earned money he was stashing away was actually losing its value. And the culprit? It's this silent thief called inflation. Just think about this number for a second. 3.8%. Over the last 60 years, that's been the average rate of inflation every single year. So what does that mean? It means if your money isn't growing faster than that, you're literally getting poorer every single day. Now let's contrast my dad's story with my own. Because I understood that one simple fact, I went down a totally different path. Instead of watching my money lose value, I made it work for me. And that helped me not just beat inflation, but build some serious wealth. The only difference between us? I invested. So here's what we're going to cover. First, we'll look at the problem, then the powerful solution, your first steps to get ready, how you actually buy stocks, a strategy that even beats the experts, and then finally, how to really think about risk. Okay, part one. Let's really hammer this home. My father's problem was the hidden risk of just saving cash. It feels so safe, right? But inflation is a guarantee that your cash will be worth less and less over time. And that brings us right to part two, the solution. This right here is your secret weapon for building wealth and absolutely crushing inflation. It's called compound interest. So what is it, really? Well, simply put, compound interest is the money that your money makes. So your first investment earns returns, and then those returns start earning their own returns. It's kind of like a snowball rolling downhill. It just keeps getting bigger and faster over time. It's incredible. Just look at how powerful this is. Let's say you invest just $250 a month and you earn an 8% return, which is right around the historical average for the market. You'd become a millionaire in 42 years. But what if you kept going for just 10 more years after that? You'd have over 2 million. So here's the key takeaway, the most important thing to remember. The number one ingredient for building wealth isn't having a ton of money to start with or some secret stock tip. It's time. The earlier you get started, the more time you give that snowball to grow into an avalanche. Which leads us to part three, getting yourself prepared. Before you even think about putting a single dollar into the stock market, you've got to build a solid financial foundation. Think of this as your pre-flight checklist. And there are two things here that are totally non-negotiable. First, you've got to pay off all that high-interest debt, like credit cards. It just makes 0 sense to earn 10% in the market when you're paying 15% or more on a credit card. Second, build up an emergency fund, enough to cover 3 to 6 months of your living expenses. This is so important because it means you'll never be forced to sell your investments at the worst possible time. Okay, once that foundation is set, let's jump into part four. How do you actually buy stocks? This is where we get practical. How much money should you invest and where exactly do you put it? A really great, simple guide is the 70-20-10 rule. The idea is that 70% of your income goes to your living expenses, 20% goes straight to investments, and, this is really important, 10% is for fun stuff. Seriously, investing shouldn't feel like a punishment. You gotta have balance. And actually buying stocks has never been easier. These modern investment apps let you open up special tax-advantaged accounts like a Roth IRA right from your phone. And the best part? You can buy what are called fractional shares. So instead of needing, say, $190 for one share of Apple, you can literally start with just $1. All right, on to part five. And this is a huge one. This is the strategy that actually beats the experts. I like to call it the lazy way to win, because it's a simple, low-effort approach that consistently outperforms those highly paid professionals you see on TV. It's all about something called an index fund. So what is it? An index fund is basically a big basket of stocks that just copies a market index, like the S&P 500. So by buying just one share of an index fund, you instantly own a tiny piece of hundreds of the biggest and best companies out there. You're diversified right away. I love this analogy. Think of the S&P 500 as a sports league, like a premier football league. You have the best performing companies right at the top of the table. If a company starts doing poorly, it gets kicked out, it gets relegated, and it's replaced by a new rising star. Well, an index fund lets you bet on the entire league, so you're always owning the winners, not just trying to pick one team. And a massive reason this strategy works so well is cost. See, because index funds are passively managed, they're just following the league, right? Their fees are incredibly low, sometimes as low as 0.02%. Compare that to actively managed funds, where some professional is trying to pick stocks. They can charge 2% or even more, and that just eats away at your returns year after year. And here it is. This might be the most powerful statistic for anyone investing for the long term. If you look at all the historical data, not one person has ever lost money in an S&P 500 index fund if they held onto it for at least 20 years. That's just the incredible power of time and betting on the market as a whole. All right, finally, let's talk about part 6, the real risk and when to sell. We all know the market goes up and down. That can be scary. So how should you actually think about risk, and when is it ever the right time to pull your money out? Look, if you're investing for the long term, and I mean decades, there are really only 3 good reasons to even think about selling. 1, you have a true emergency that your emergency fund can't cover. 2, you picked an individual stock and the company is fundamentally failing. Or 3, you've hit a big savings goal, like you're ready to buy a house. That's about it. This is what it all comes down to. We have to completely change how we think about risk. Yeah, the fear of a market crash feels big and scary, but the guaranteed risk, the one that is 100% certain, is not investing at all. It's letting inflation just silently eat away at your savings, just like it did to my dad's money in that shoebox. And that brings us to the final question, and this one's for you to think about. After hearing all this, what do you now believe is the biggest financial risk that you're actually facing? Is it the temporary ups and downs of the market, or is it the absolute certainty of losing money by doing nothing at all?